A very good evening, everybody. Welcome to the live webinar on Options Trading Mastery, Unlocking the Power of Covered Calls. I'm Ming Hui from Flip Nova, and speaking to us tonight will be our very own senior investment analyst, Danish Lim. Before I pass the time to Danish, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, over to you, Danish.
Okay, thank you, Ming Hui. I hope everyone is able to see me. So I'll go ahead and share my screen and we can begin with today's webinar. So hopefully you guys are able to see the slides that I have. And like Ming Hui mentioned, my name is Danish. I'm investment analyst for Philip Nova. And today I'll mainly be talking about some of the option strategies, as well as perhaps more of a focus on covered calls. So for some of you, perhaps who are more experienced in trading options, you may be aware of what are covered calls, as well as some of the more other complex strategies. But I'm pretty sure, this session may help you refresh your memory, and maybe perhaps you guys will be able to learn something new. And for the newer members, people who are more, uh, more newer in trading options, I believe this session will be very helpful to you. So before we proceed, I'd like to highlight that this presentation is intended for general circulation and educational purposes because we do not take into account your specific investment objectives, your financial situation, as well as your particular needs. So this is a rough outline of today's webinar. I'll kick things off by giving a short introduction, as well as sharing some of the definition, benefits and risk of covered calls, and then some real life examples of how covered calls work. And then I'll move on to a more complicated strategy, which is the options collar, and how it works by combining covered calls as well as with protective puts, as well as some real life examples. So first things first, there are a lot of option strategies out there, and this is a very simple table showing some of the more basic option strategies. You can see that different options, for example, buying a call, selling a call, buying a put, they are all suitable for different market views. For example, if you're bullish on the market, uh, the idea is to go long a call, while if your view is that you want to enhance your income, uh, the idea is to short a call. And for today's webinar, we will be focusing on the covered call as well as the option collar. So the first thing to address is maybe some of you guys, a question may have popped up in your mind. Why should I execute an option strategy? Why should I go through the hassle of making things more difficult for myself? Option strategies aren't very simple, as maybe perhaps going just long a stock or going long a futures, for example. So there are a lot of benefits. First things first, using options and option strategies provide you with risk management. Certain strategies like protective puts, for example, can protect you against downside risk, as well as generate additional income when markets are flat. So I'll talk more about this when we come to protective puts and covered calls. Option strategies also provide you with a lower cost way to either long or short a market. I'll elaborate more on this when I talk about the zero cost collar strategy. Additionally, option strategies also gives you the ability to potentially profit in any market condition. That sounds quite amazing, right? So different option strategies allow you to profit in up, down, or sideways markets. And perhaps more amazingly, you don't even have to actually rely on price direction or market direction. There are option strategies like straddle and strangles where you are taking advantage of the volatility in the markets rather than just price direction. Of course, like I mentioned, strategies like covered calls will generate additional income, and this is perhaps the best when markets are flat and mildly bullish. And lastly, I think option strategies provide you with the ability to customize your investment based on your specific market outlook. For example, covered calls and option collars, they are best when markets are mildly bullish or when they are range bound. because you will be able to generate additional yield or additional income. We also have straddles or strangles for volatile markets, either to the upside or the downside, as well as iron condors or butterflies, which are best when you expect limited movement in the market. So for today's webinar, we will be focusing on covered calls and collars. Um, I will probably be covering straddles, strangles, iron condors, and butterflies in next month's webinar. So for those who are interested, do tune in to next month's webinar. So to kick things off, let's talk about option strategies. And for perhaps some of the newer option traders out there, let's first talk about when you long a call. So when you long a call, typically your view is that you are bullish on the market and you essentially are hoping for the underlying price to go above the strike price. And a very easy way to sort of calculate your payoff as a call buyer is through this formula, which I always use S minus X. S is basically the underlying price, while X is the strike price. So a very simple way to easily remember this is to understand that when you go long a call and when you exercise a call, what you are essentially doing is that you will be able to buy the underlying. It could be gold, it could be an index futures, for example. You will be able to buy that underlying at the strike price. So when you buy something for at the strike price, is you can see it as a cash outflow because you are paying for something, and this is why you include a negative sign in front of the X, which is the strike price. And the idea is that when you buy, for example, the S&P 500 futures at a strike price, you can, and if the market is bullish enough, you will be able to sell it at a higher price. So typically, when you go long a call, there's three different scenarios. The best scenario is when the underlying is above the strike price, which is what we call in the money. And like I mentioned, the payoff, you can easily calculate it with the formula of underlying minus the strike price. On the other hand, we have other scenarios, for example, when the underlying is equal to the strike price and when the underlying is below the strike price. They are called at the money and out of the money. And because the option won't be exercised, the payoff as a call option buyer will be zero. However, I think some, especially newer option traders, they sometimes forget that the option payoff doesn't equal your profit on the trade. You have to remember that when you gain, when you own the option, especially when you go long an option, you need to pay an option premium. So for the profit to the call buyer, the formula is also quite easy. It's simply S minus X, and then you deduct the call premium that you're paying. So this is a very important formula. Hopefully for the newer option traders, you guys maybe take a picture so that you can remember it. So on the other hand, when you go long a put, your view is that you're bearish a market. And again, the payoff is essentially, the opposite of a long call. It's S minus X. And a very simple way to memorize it is that, when you exercise a put, you are essentially exercising the right to sell a certain underlying at the strike price. So when you sell an underlying, you are receiving cash, right? Because you sell something and then you receive cash. So your X has a positive sign in front. And the idea again is that you'll be able to sell an underlying at the strike price. And then you essentially buy it at a higher price on the market, which is why the underlying or S has a negative sign in front. So again, things are mostly the same. We have three scenarios. Typically for long put, it's in the money when the underlying is below the strike price. So it's the same as a long call. Payoff of the option doesn't equal to the profit that you're receiving. And the formula is relatively the same, S minus X, and then you deduct the premium that you're paying for your long put option. On the other hand, let's say you are short a call, meaning you're writing a call, or more simple term would be selling a call. Typically, your view is that you're bearish or neutral on the market, and your goal is that you want to generate additional income. So again, a simple way to think of the three different scenarios is to very simply, put a negative sign over all the long call, payoff scenarios that I mentioned. So you can see, for example, when for a short call, when the underlying is above the strike price, this means that it's in the money. And then the call buyer, which is the opposite side of the trade, will exercise their call option. So as a call seller, you're essentially losing. So all you have to do really is to just put a negative sign in front of the payoff or for the long call option. And the main reason is because as an option seller, you're obligated to deliver the underlying to the call buyer. On the other hand, the best case scenario when you're a call seller or option seller is when the option remains at the money or out of the money because the option will not be exercised and you will be able to receive premiums. And that's one of the biggest difference when it comes to shorting a call or going long on a call. When you go long an option, you are paying premium, so it's outflow. While if you're shorting an option, you will receive premiums, and it can be seen as generating additional income. So you can see from this chart on the right, maximum profit for a short call position is limited to the premium, which in this case I give an example of $4. Uh, you will be able to receive this premium as long as the option is not exercised. However, a very important thing to note for a short call position is that the risk that you're exposed to is theoretically unlimited. You can see on this chart over here, and I've even included a circle, the risk of this is option payoff diagram. You can see that the loss, the y-axis is a profit loss P&L, the x-axis is the price of the underlying. So you can see that this loss that you're suffering is theoretically goes to infinity because the underlying price can rise to any amount. And as a call seller, you are essentially on the losing end as long as the underlying increases in price and the call buyer exercises his or her options. So this is a important thing to understand when you're going short on the call, that the risk reward ratio is very skewed towards risk. Uh, the risk that you're exposed to is theoretically unlimited. And this is what we call a naked or uncovered call. So then, frequently we also sometimes hear a very common questions. So why would anyone even bother to short options when the risk that you're exposed to is theoretically unlimited? So there are certain facts that we have to be aware of. According to data from the Options Industry Council, option sellers, they have a higher average win rate of about 60% versus buyers at 40% over the past 15 years. And what we also other a lot of studies have also shown that around 70% or more of options, most of them actually expire worthless. And again, you remember that when you short an option, your main goal is that you want the option to not be exercised. You want to continue receiving premiums. And the reality is that most markets out there, they only experience very infrequent bouts of volatility. And roughly, most of the time, markets will remain rather flat and rather, range bound. And that is why, on average, option sellers tend to have a higher winning percentage versus option buyers. So then the next question that probably comes to your mind is, when should I go long an option and when should I short an option? You can see on this table I provided. Typically, the best case scenario to go long an option, long call or long put, is when volatility is high. And on the other end, the best time to sell options would be when volatility is going down or when it's low. So there's a couple of reasons. Firstly, when volatility is low, it means that the probability of large unexpected moves decreases. And this is actually a win for the option writer because the option is less likely to be exercised. And this is why, and it's a very important concept to understand. Newer option traders may struggle with this concept because we tend to think of volatility as a very negative thing. It has a very negative connotation to it. But in the world of options, volatility can be your friend. So as I've mentioned, when volatility is low, essentially the market remains very calm, and this is best when you sell an option because if the underlying doesn't move by much, this means that the likelihood that it will be exercised by the call buyer is lower. So this is the best time to sell option and continue to receive the premiums. On the other hand, for neutral or undecided market, you can also short strangles, short straddles, which is outside of this webinar. But essentially, like I mentioned previously, straddles and strangles, their main goal is to profit from volatility rather than price movement. So now I've gone through, I've introduced, some of the option strategies out there, as well as when to long, when are the best time to long and short an option. So now let's talk about the theme of the day, which is covered calls. So like I mentioned previously, we do, I've talked about the uncovered or naked call, where you simply go short a call, and when you do so, you collect premium, but you are exposed to limited reward, which is the premium that you receive. You can see from this chart over here, I actually really like looking at option payoff charts because it's very simple to understand. You can see that it's horizontal over here, which essentially tells us that the profit you receive is maximized, uh, you know, based on the premium that you are receiving when you go short a call. And the risk is unlimited because it theoretically stretches out to infinity. And this is because, as an option seller, you will essentially have to buy the underlying from the market at a higher price. A buyer exercises their option, you are obligated to deliver the underlying to them. So let's go through some examples of naked calls. Over here, I have the S&P 500 E-mini futures December 2024 contract. Currently, it's maybe about, again, these are all hypothetical numbers. Currently, the spot price is about 5,700. So let's say we short an European call, which is 5% out the money. For those of you who are unfamiliar with this, 5% out the money, the percentage number is essentially how far away the strike price is from the spot price. So essentially 5%, the strike is 5,700, which is the spot, plus 5%, and that gives you your strike price. And by selling this European call, we receive a premium of about $33. So like I mentioned, your profit is actually it's maximized uh, according to the premium that you receive. And the break even can be calculated by taking the strike price plus the premium. And the loss for naked call position, the formula over here, essentially uh, it's either zero or the negative underlying minus strike. This bracket I put over here, it's dependent on whether the option is exercised or not. If it's not exercised, the option payoff is zero, and the option seller will benefit because the option is not exercised and he'll continue to receive premiums. So let's say the first scenario, the S&P 500 futures, December 2024 contract drops to 5,200. You can, follow this, scenario on the chart I provided, or you can, calculate it based on the formula I provided. So you can see that as it drops to 5,200, what happens is that the profits will be maximized at $33, which is the premium I received. It doesn't matter, it could drop to maybe 5,000, it could drop below 5,000, it could drop to 4,000, but the premium will ultimately remain at $33 based on this chart I provided. On the other hand, let's say the S&P 500 rises to 6,400, which is above the strike price of 5,985. We see that we have a loss of about negative $382. On the other hand, let's say it rises to even higher, it rises to 6,800, your loss will be even higher at about $782. So essentially, the further up the S&P 500 rises, the greater your loss will be. And there is no theoretical limit to how high the S&P 500 can go, which is why we say a naked call position is exposed to unlimited risk. So I think something maybe you are curious about is, why does this chart look so flat? The This is because the premium that you're receiving is very low, and this is because it's an out the money premium. And you can see that the chart uh, appears very different when you essentially sell an in the money call. You see, and what happens when you sell in the money call is that the premiums you receive will be higher. Why? When you sell an in the money call, what essentially it means is that you're selling a call where the price is very favorable for the option buyer already. Therefore, as a call seller, you essentially demand higher premium in order to sell the call option. However, this doesn't mean that you should always sell an in-the-money European call, or you should always short, in-the-money calls. The trade-off is typically that in-the-money calls have a higher likelihood of being exercised, which, like I've mentioned, is because the option is already in a favorable, it's already favorable for the call buyer, and perhaps a bit more complicated. Talking about option deltas, in the money options typically have higher deltas. And for those of you who are familiar with option Greeks, higher delta essentially means that the option is more sensitive to changes to the underlying price. So when you sell an in the money call, it's more sensitive to changes in the underlying. And remember, as a option seller, your main goal is that you don't want the option to be exercised. So you don't want it to be very sensitive. You don't want the option to be sensitive to changes in the underlying. So what you ideally should have is an option that is not very sensitive to the underlying, and options that have the lowest delta typically are out the money options. So again, I've simply changed the type of option. The previous example is a 5% out the money call option. It is a 5% in the money call option. You can see that with the same scenarios, your losses are magnified. You may receive higher premiums, but again, your losses increase. So then the question comes, how can I exit a short call position? The first way to do so will be to simply wait for the option to expire. Options have expiry dates. Uh, if it expires out the money, you will essentially be able to retain your premiums, and that's the best case scenario for option seller. However, if it's in the money, you have to do what we call assignment, where you have to deliver the underlying to the call buyer. So what you have to do is, if you, for example, have the underlying already, let's say you already have a S&P 500 futures position, you have to sell it to the buyer at the stated strike price, or you will have to buy it in the market at a higher price just to deliver it to the option buyer. On the other hand, you can buy back the call option, and this is very simply to just close out your short position. And in this case, it is actually possible to see a small profit due to what we call theta decay. And again, this is actually a bit more complicated. It relates to option Greeks. When we talk about theta decay, it's time decay. And what this means is that the value of your option, the closer it is to expiry, it actually decreases in value as the option approaches expiry. So what this means is that, let's say you want to buy back a call option. Let's say the number of days to expiry, maybe it's like 10 days, and nearing the expiry, maybe on the 9th or 8th day, you may be able to buy back the call option at a lower price than when you actually uh, initiated your short position. However, this is also dependent on if the volatility doesn't increase. Of course, the third option is to simply roll your position either to a later expiration date or a different strike. So now that we've talked about naked calls, and hopefully you guys are aware of the risks of a naked call, let's talk about covered calls. Sometimes it's also called a buy right option because, as I will be speaking further on, a covered call strategy, you're essentially buying the underlying and then you write or sell an option. So for covered calls, the main goal is that you want yield enhancement. You want to receive the premiums while not having your call option being exercised. So typically, a covered call involves shorting a call option as well as the purchase of the underlying. And this also works if, let's say, you already have an underlying position in, for example, gold futures. And if you proceed to short a call option on the gold futures contract, you are essentially opening or initiating a covered call option strategy. And a covered call strategy can be depicted with this option payoff diagram. Again, I've mentioned that I like to see option payoff diagrams because I think it's very simple to understand. You can see over here that the green line, which is the profit and loss line, it's essentially horizontal past the strike price. So what this means, hopefully you guys are able to interpret it this way as well. This means is that for a covered call strategy, the best case scenario is when the spot price, which is this blue vertical line over here, best case scenario for a covered call strategy is when the spot price, when the underlying rises to between the current spot price and the strike price. You can see as well that your profit is limited or it's capped at the premiums that you receive. So let's give some examples, which hopefully makes it easier to understand. Let's say we go long an index XYZ at $20 and we short a call with a $30 strike. And in exchange for shorting that call, we receive a premium of about $1.50. Again, this is the option payoff diagram for a covered call strategy. So you can see that as long as the index trades below the strike of $30, which is over this line over here, you will be able to collect your premium of $1.50 because the call option will not be exercised by the call buyer. On the other hand, if the index trades above $30, which is above, which is when the payoff diagram starts to become horizontal, your call option will be exercised by the buyer, and as a seller, you have to deliver the underlying that you already hold at the strike, which is why your profit is capped, it's limited, and it becomes horizontal. So this simply means that when you do a covered call strategy, you are foregoing upside participation if the underlying rises above $30. And this covered call strategy is best when your outlook is for a stable or a market that is range bound. For example, if your view is that the index XYZ will trend or increase slightly, maybe, but it still hover around this $20 to $30 range, which can be you can see over here this diagram. This is the best case scenario, or what we call the Goldilocks zone. Of course, the risk that you have, that the premium that you receive, it does somewhat provide some downside protection, but if the underlying declines enough, it can still result in significant losses. As you can see from this diagram over here, if the underlying price, which is the x-axis, drops, drops significantly, you will still see significant losses, which is based on the y-axis. So like I mentioned, the Goldilocks zone when for a covered call strategy is when the market is mildly bullish or range bound. So the Goldilocks zone for this will be the break even, which is the underlying price minus the premium. So it's between $18.50 and the strike of $30. And I've also included the profit formula for a covered call strategy. Again, you essentially have three different calculations to do. You have the change in your underlying position. Remember that a covered call strategy, you go long the underlying. So you have to calculate your profit or loss on your underlying position. For example, your long index XYZ, and then you have to deduct your option payoff. It could be zero if the option is not exercised, or it could be a positive number if the option is exercised. and then you have to add in the call premium that you're receiving. So going through several different scenarios, firstly, let's say the market is in uptrend or index XYZ goes above $30. You will still make the same max profit because your call option is in the money and the call buyer will exercise it. And as a call seller, you essentially no longer own the underlying you have, so you sell it to the call buyer in exchange for the strike price. On the other hand, let's say the market is range bound, maybe between 20 to 30, you actually outperform, the cash index because you will benefit from the increase in underlying as well as the additional premium. And this is why we say that covered calls can be seen as a yield enhancement strategy. And this is the best case scenario because you benefit from the increase in your underlying position as well as the additional premium from shorting the call option. Other than that, when the market is on a downtrend, let's say index XYZ decreases, you can profit if the decrease in the underlying is smaller than the call premium you're receiving. However, if the decrease is bigger than the premium you're receiving, you will still see a loss. So to summarize, a covered call provides you with, you know, uh, you know, is best when the market is range bound, and it may also, help offset some of the decline in your underlying position. So let's give another example. Let's say you own the futures, position in S&P 500 E-mini contract, but your view or your market outlook is that the price of the contract will rise in the near future, but it will be unable to break resistance at $6,000. If you're keeping up the markets, I think $6,000 is a very important resistance level. So what you do is that because you believe that it will not break resistance at 6,000, what you can do is that you sell out the money call options at $6,000 and then you continue to receive premium. And this serves as additional income for your overall position. So again, like I mentioned in this example, let's say we go long the S&P 500 E-mini December 2024 contract. The underlying price is 5,700 and then you short and out the money European call option. Uh, I think there's a typo over here, but again, because you believe it will not break resistance at 6,000, your strike in this scenario is $6,000, and in exchange for selling this call option, you'll receive premiums of $28. So again, I provided the formula for the break-even point as well as the profit formula, which I shared previously. So in the first scenario, let's say the S&P 500 rises to 5,900 from $5,700. What happens is that your short call option, because it's not yet above the strike of 6,000, it's not exercised, and the call seller will still continue to receive the option premium. So a very easy way to calculate is that you will benefit from the $200 increase in your underlying. You can see that your futures contract rises from 5,700 to 5,900. So you see a $200 profit, and then you top up and you add on your additional $28 premium. So you will be able to outperform your position or the normal cash position or your normal position. On the other hand, let's say it rises to 6,400, which is actually above the strike price. We see that it gives us a profit of $328. And you understood what I've mentioned, you will know that your profit is actually capped or maximized at $328 because when it's above the strike price, as a call seller, you have to deliver, you have to sell the underlying to the option buyer. So essentially, your profits will be limited at $328. And what happens is that you will underperform, the regular cash market. On the other hand, let's say the S&P 500 drops to $5,200. Your loss will be $472, but this is a relative outperformance because let's say you don't have this option position you are simply long this futures contract, your loss will be about $500 because it drops from 5,700 to 5,200. However, you will still receive your premiums, and your premiums received will help you offset your overall losses. So, in summary, I've provided a table over here. Hopefully, if you guys still aren't very sure, you guys may, feel free to take a photo of this, and do leave some questions in the Q&A. So for a covered call, typically it's executed when your market view is that you believe the underlying will be mildly bullish, or if it's range bound. So what you have to do is that you go long the underlying, for example, the S&P 500 futures, and you sell an out the money call. Some advantages of a covered call strategy is that it still generates income from your holdings, as well as benefit from three directional movement. A mild increase sideways market or range bound market, as well as a slight decline, because the premiums received will be able to offset the decline. So the reward is that you earn premiums, but for the risk, again, it's not unlimited, because it depends on how much underlying falls. And like I mentioned, your upside potential is capped, because the underlying will be delivered once the underlying price is above the strike price. So hopefully you guys have a better idea of what the covered call strategy is. So to do a short comparison for a short call or a naked call, typically your view is you're bearish on the market. You can see over here that you will see some profit if the underlying falls, if it underlying goes to the left, which essentially means the underlying price declines. The blue vertical line, is the current underlying price. However, your risk, like I mentioned, is unlimited, because this chart over here theoretically can go to infinity, because there's no limit to how high an underlying price can go, and your reward is limited to only the premiums that you receive. So, a basic, trading, I would say, mantra is to always manage your risk reward ratio. And a short call, I would say, it's not very favorable in terms of risk reward ratio. Of course, you can sort of limit this risk with a covered call strategy. Typically, you do this when you're flat or mildly bullish on the market. You go short a call, and as well as you go long the underlying. Your risk is maximized when the underlying goes to zero. So it's not when the underlying stretches to infinity. Your risk is also slightly offset by the premiums that you receive, but your upside potential, as you can see from this chart over here, is capped and limited. And the reward you receive is some upside participation as well as the premiums. So now that I've talked about covered calls, let's move on to options collar. So first things first, let's talk about a protective put. A protective put, essentially, you do it when you want to protect a long position. Essentially, you go long an asset and then you long a put. So you buy an asset and then you buy a put. The chart is very simple. It's sort of like a slanted L shape. You can see over here, hopefully right off the bat, that your risk is limited. It's capped. Your risk is limited because of the put option. So typically it's used to hedge downside risk while still maintain some exposure to the upside. But your upside will actually underperform the cash market because of the premiums that you're paying. Remember that for a long put option or any long option position, you have to pay option premium to own the option. So let's use an example. Let's say we are long COMEX gold futures, and let's assume that the price of the underlying is at $50, which can be seen from this chart over here. And let's say we go long a slightly in the money put with a strike price of about $45. In exchange, we pay a premium of about $2. Again, for a profit formula for a protective put position is given by this formula over here. Because you are long an asset, you have to calculate your change in the underlying position. And this zero, x minus s is the formula for your option payoff. And then again, you are paying premiums, so you have to minus the premium. So let's say your market is on the uptrend, gold prices increase to $70 from $50. So it's a $20 return. You see that with a protective put position, sure, your underlying, you see a $20 return, but you have to actually deduct your premiums that you pay. So your overall profit for a protective put position is $17, which is lower than a non-protective put position. It's $20 versus $17. So again, your upside is unlimited. You see again that this chart over here stretches out to infinity, but the premiums that you pay for the put will reduce your total return. On the other hand, let's say the gold market is on a downtrend. Gold drops to $30 from $50. So without the option, you will see a $20 loss. However, with the protective put strategy, you can see that your negative $20 loss will be offset by your put position. When you exercise a put, this is the payoff you'll see, which can be easily calculated with the formula x minus s, and then you deduct your option premium. You'll see that your losses will be limited to just $7, which is a lot lower compared to the $20 loss without the put position. And even further, let's say gold drops to $20, which is down from $50, your loss will still remain at $7. And this is why the profit and loss chart over here, it becomes horizontal because your loss will be limited. It will be capped at $7 thanks to your long put position. So a protective put, uh, the main benefit is that it provides downside protection as well as some capital appreciation. So you do benefit from some of the upside profit, but your overall return will be lower because you'll be paying premiums for the long put position. So now let's talk about option collars. Essentially, an option collar, you can consider it as having a covered collar plus a long put, or a protective put plus a short call. Now, it may be a little bit complicated, but this, as you can see on the right, this is how an option collar strategy should look like when it comes to a P&L diagram. It's sort of a mirrored Z. How you can construct this strategy is to go long and underlying, and then you short and out the money call. And if you guys recall, a long underlying and short out the money call is a covered call strategy, and then you plus a long at the money put. So if you were to do these three actions over here, it should give you a options collar payoff diagram. There are, however, three rules that you need to follow when you want to execute this strategy. The options have to be the same expiration date because, like I mentioned, if the options have different expiry dates, the theta decay will be higher and lower for different options, and the payoff will not be ideal. So your call strike should also be higher than your put strike, and of course your position sizes should match for your options. So let's proceed with an example for options collar. Again, let's say we are long the S&P 500 futures at about $5,700. And like I mentioned, to execute a collar strategy, we long and at the money put, which is about 5,600. So because we are long an option, we have to pay a premium of about $77. And because we're short a call, we will receive a premium of $35. So the break-even point can be calculated by the price of underlying minus the call premium that you are receiving plus the put premiums that you're paying. And it gives us a break-even point of about $5,742. So essentially, the break-even point tells us that we will start to see profits once the S&P 500 futures goes above $5,742. So the break-even point is quite important to remember and take note of as well. And then we also have the outlay. And when I say outlay, it essentially means our cash outlay or cash flow. Uh, and this is important because this options collar strategy involves two different options. So for put premium, again, we are paying the premium, and for call premium, we are receiving it. So overall, yeah, overall premiums that we are receiving, it's a net, it's a negative $42. We have to pay overall cash outlay of $42. So this outlay can either be a credit, which lowers the cost of your position, or it could be a debit, which adds to the cost. So what it means is that when you combine the premiums that you're paying and the premiums that you're receiving, the overall cash that you need to pay for this collar strategy will be $42. Because the premiums you're paying for the long put option, which is $77, you're paying more than the premiums you're receiving. So I hope you understand this concept as well. So let's go through different scenarios. Let's say the S&P 500 futures falls to about $5,400. You can follow this chart over here. The blue line is essentially the underlying, and uh, you know, again the y-axis is profit and loss. The x-axis is the strike price. So let's say the underlying falls to 5,400. You can simply imagine, you can follow my mouse over here. The blue line over here shifts to the left, maybe around somewhere here. You can see that, your loss will be kept according to this payoff diagram. So what happens is that if the underlying falls, your long put will be in the money, while your short call will expire worthless. So if you were to continue calculating, you can see that the payoff on your put, which is given by the formula, strike price minus underlying, your put payoff it'll give you an overall positive payoff of $200. So this will offset your losses from your long underlying position. Because you're losing, you're seeing losses when the S&P 500 futures drops from 5,700 to 5,400. So again, like I mentioned, your loss on underlying is negative $300. So again, this means that your net position, if you were to include the $42 in terms of total premiums paid, which I told you previously, your net position is a loss of about negative $142. So this loss of 142 is the maximum loss that you're seeing. It doesn't matter if your futures position maybe drops to 3,000, maybe it drops to 4,000. Your loss is capped at $142. On the other hand, let's say the S&P 500 futures is range bound. It trades between the current, trades between the strike of about 5,600 to $6,000. And what happens is that both your call and put options will expire worthless. So again, looking at the chart, if the futures or the underlying trades between 5,600 and 6,000, so it will be around this range over here, or when the line starts to curve up. So in this scenario, your both your call and put options will be expire worthless. So your net payoff from your option position will be zero. And what this means, so it's very easy to calculate your overall profit. It's very simply just the change in underlying plus your payoff from your options, and then you deduct your cash outlay in terms of the premiums that you're paying. On the other hand, let's say the market is very bullish, the S&P 500 futures goes above $6,000. Let's say it goes above $6,000 over here on the chart. Your call option will be in the money, while your put option will be expiring worthless. And again, because your call option is in the money and you're short call, you have to deliver the underlying to the call buyer. So if underlying is at, let's say for example 6,100, the change in your underlying position will be $400. Again, because remember the spot price is 5,700. However, because you have a short call position, uh, and the call will be exercised once it goes above 6,000, the net payoff will be negative $100. And if you include your net cash outlay, which is negative $42, your profit will be maximized at about $258, which is why the green line turns horizontal over here. So, it's probably a bit complicated and a bit heavy on the content, but I have summarized the option collar strategy. Typically, the option collar is executed when your view is that the market will be mildly bullish. So it may maybe rise like 4-5%, but not by a lot, but it still rises. But at the same time, let's say you are mildly bullish, but you're very concerned with risk and you want to protect either your profits or your losses. So this is the ideal time to execute an option collar strategy. So it's a three-legged option strategy. So you go long an underlying, you sell out the money call, and you go long a near at the money put. Some advantages of an option collar is that it helps protect profits on your underlying position. And it's also possible to reduce the cost. And when I say the cost, I'm referring to the cash outlay, which I previously mentioned, the negative $42. And I think we'll be talking about that next when it comes to the zero cost collar. So for a collar, your rewards are limited and your risk is limited. And you'll see max profit when the underlying price goes above the call strike price. You will see maximum loss when the underlying falls below your put strike price. So feel free to take a picture of this. I believe this is a good summary of what the option collar strategy is about. So now let's talk about zero cost collars or costless collars. So typically, a zero cost collar is initiated or executed when a call option is sold with a premium where the premium you receive on shorting the call is equals to the premiums that you pay for your long put position. So your net cash outlay in this scenario will be zero because the premiums you receive and the premiums you pay are equal to each other. So in such a scenario, you can essentially fully protect your existing long position with little or no cost. But in reality, this zero cost collar could be a little bit difficult to execute because it's pretty difficult to find an exactly equal premiums for a call and a put position. In reality, it's probably a little bit more practical to achieve a little cost or essentially reducing your cost of your option collar. So for example, let's say we want to use the costless collar strategy to protect our profits from our underlying position. So in this scenario, let's assume that you are an investor. You have a long position in gold futures, and as we all know, gold has been very bullish recently, and let's say it's risen by over 20%. So we have an unrealized profit of over 20%, and we want to hold and we want to protect this 20% profit. And currently, let's say gold is at $2,650. So let's assume that this investor, he initiated a costless collar strategy to protect his profits. So although he believed, in the potential of gold prices in the long term due to the Fed cutting interest rates, he is worried that, a lack of clarity over China's stimulus, very, uncertain geopolitical tensions, as well as an uncertain rate cut trajectory may weigh on gold prices. So there's a lot of uncertainty, and he still wants to protect his profits. He wants to protect the 20% it is earned, and he also sees support level at about 2,600, which is below the current spot price, and he sees resistance at $2,800. However, let's say there's a sudden de-escalation in Middle East tensions, and what happens is that the gold price plunges. It sees a sudden drop to $2,400. So in this scenario, let's say he has already executed a costless collar strategy. What he can do is short and out the money call at the resistance level, maybe about 2,800, and as well as long and near at the money put at a strike of 2,600, which is the support level. And in both scenarios, again, this is hypothetical. Let's say the premium received for the short call position is $10, and the premiums he paid for the put position is $10. And in other words, he's essentially paying $0 just to execute this costless collar strategy. And the proceeds or the money or the cash that he received from shorting the call can essentially be used to pay for the long put option. So there's three different scenarios. Again, let's say the price of gold falls below the put strike and it ends up at $2,400. What happens to your options is that your short call will expire worthless, while your long put option will be in the money. So for your option payoff, again, your for put option, your payoff is given by the formula X minus S, which is strike price minus underlying. So you see a net positive payoff for your long put option of $200. So the gains of this $200 will help to offset your losses from your underlying gold position. Okay, let's say that the current gold price is about 2,650 and it drops to 2,400. So you have seen a loss of $250 without the option collar strategy. And this will impact your 20% return. However, with this costless collar, it will essentially just limit your losses to just $50. So that's one of the benefit. You are able to sort of protect your profits. Instead of having your 20% return being reduced to maybe 15%, maybe with a loss of just $50, your overall profit may maybe just drop to maybe 19.5% or 19%. On the other hand, let's say gold prices they trade between both option strike prices. Again, this means that both your call options and your put options will expire worthless. So your payoff from your options will be $0. And you will simply benefit or see profits from an increase in the underlying. So you will gain $100. And this is probably the best case scenario. On the other hand, let's say that gold prices rise above the call strike, and this means that your short call position is in the money, and your long put option will expire worthless. So the payoff for a short call position is a negative underlying minus strike price, and when your short call is in the money, and in this scenario, if gold rises to 2,900, you will see a loss of about $100. So again, your gain in underlying will be about $250. And because your call is exercised by the call buyer, as a call seller, you will see a loss of $100. So your net position will be 150, and this is lower than without the collar, which is $250. So this is, I think, a good summary of the costless or option collar strategy. Remember that it's a Z shaped. Let me return over here. It's a Z, it's a mirrored Z shape. So your upside is somewhat limited, and your downside as well is also somewhat limited. So, I finished talking about the options collar, and I'll end things off by providing a summary of most of the stuff which I talked about, which I understand could be a little bit more complicated and a bit too content heavy. So, like I mentioned, when is the best time for traders to potentially go long on options as well as short options? Typically, the best time to long options will be when volatility is high, because higher volatility means that there is higher likelihood that your underlying price, let's say the S&P 500 index, sees very large price movements. And large price movements means that there's a higher likelihood that, for example, your underlying can go above your strike price. And this is why typically you'll go long options when volatility is high. On the other hand, when volatility is low, which means that the markets are very calm, markets are range bound, it could be the good time to go short on options, because there's a lower likelihood that your underlying will be exercised or your option will be exercised. And as a call seller or option seller, you can continue to benefit, and continue to receive premiums as long as your options are not exercised by the call buyer. So again, I've covered two strategies as well, the short call or naked call, as well as the covered call. Uh, Again, going through all these strategies, short call, you typically do it when you're bearish on the market. Uh, you can do it very simply by going short on the call option, but your risk is unlimited. Again, from the payoff diagram, your risk essentially stretches out to infinity because there's no limit to how high an underlying price can increase. But your reward is only limited to the premiums that you're receiving. On the other hand, for a covered call, where you go short a call and you plus a long underlying position, you typically do it when your view of the market is flat or mildly bullish, and your rewards is that you gain some upside participation as well as the premiums from shorting the call. Of course, you do still face risk, which is maximized when the underlying drops to zero. This loss, however, is slightly offset by the premiums that you receive, and at the same time, your upside potential will be limited. Once the underlying is once the call option is exercised. So hopefully you guys are able to digest this information, and feel free to take a photo as well. So covering two other strategies, we have the protective put, which I've mentioned is, like its name suggests, is to protect against downside risk. But at the same time, you don't want to fully close your underlying position, but you must be willing to accept that your upside is limited. You'll underperform position without put because you still have to pay premiums, which is why your reward is reduced by premiums, but in exchange your risk is limited, which is why the P&L diagram, it's essentially horizontal, which means that your loss will be limited, and this is because of your long put position. On the other hand, a collar essentially involves a long underlying position. For example, you go long on gold futures, and then you add a long put position, and then you add a short call position. The best time, or typically this is executed when you are mildly bullish on the market, and when you want to protect your profit or reduce your cost of your position. And again, you can see that for this strategy, your risk is limited and your reward is also limited, which is why there's two areas where the chart is horizontal. It's horizontal when the underlying falls below 5,600, which means your loss is limited, and it's also horizontal when the underlying rises above 6,000, which is when your reward is limited as well. So feel free to take a photo for this, before we proceed. So I think we are reaching the end of this presentation. I do have just a few more slides and just a market tip. Um, there is something that is called the put call ratio or PCR, and this is a very useful indicator that I like to share. And essentially, the PCR ratio or put call open interest ratio it sort of serves as a very good market sentiment indicator. For those of you who are unaware, open interest essentially tells us the number of open option contracts or the number of outstanding option contracts that have not been closed, that have not been liquidated by either an offsetting trade exercise or assignment. So essentially, if you look at the put call open interest ratio, a higher PCR ratio means that there are more put option contracts than call option contracts. And again, just to recall back, when there are more put options on the market, or when there are more put options being traded, this means that the market has a more bearish view. And if the ratio is lower, this means that call options open interest is higher than put options, which means that the market is more bullish currently. So this is a very good indicator to just very generally try to see what the mood is like in the market what sentiment is right now. And this chart I provided is actually for gold futures. The current last price was about 2,655. The put call open interest ratio, I think a couple of days ago, was at about 1.05. So this means that the number of put open interest is higher than call open interest. And the important thing is to compare it with the median, or the average uh, put call open interest ratio over the past 5 years. So you can see over here, this blue dotted line is the median PCR ratio. And over the past 5 years, the median is about 0.73, and right now it's at 1.05, which means that there are more put option contracts than call option contracts, essentially, for gold futures. And you can essentially just take it as a view of how the market feels about gold prices right now, which means a higher PCR means that the investors are more bearish on gold. So to end things off, why should we use options and option strategies? There's a lot of benefits. I showed this slide in the beginning, but let's go through it again. Again, option strategies and options as well allows you to manage your risk. Strategies like protective puts can help you protect against downside risk, while at the same time, covered calls can help you generate income when markets are flat or when markets are very mildly bullish. And again, if you were to recall the zero cost or costless collar, their options strategies or options also provide you with a possible way to lower your costs uh, of longing or shorting the market. Again, option strategies also provide you with the ability to potentially profit in any market condition. It also gives you income generation, and I think the best aspect of option strategies is that it allows you to customize your investment to fit your specific market views. And again, like I mentioned, for covered calls and option callers, you should do it when you want to enhance your yield, when you want to generate additional income, and when your view is that the markets will be range bound or very mildly bullish. And that brings me to the end of my presentation. Thank you for listening. I hope the content isn't too heavy. If you do have any questions, do feel free to approach me through the office hotline or through my email. And I think we will now move on to the Q&A session. So let me just take a look at the questions or any questions that have been posted. So I think we may be a little bit short on time, so I'll maybe just address about 3 questions. So I think firstly, how can we see the PCR? Is it available for every underlying? This is asked by Lionel. So Lionel, to answer your question, right, this PCR, it is available, but not for every underlying. I believe that some CME options do have the PCR number, but of course, if you want to have the PCR ratio, you can very simply just email us. I am able to essentially generate the ratio for the through Bloomberg, which is how I generate it for the gold futures contract as well. So I hope that answers your question. Uh, Looking at the next question by Ganesh, who asks, will we be able to see the recording? I'm not sure about that, but we'll share the recording. Just do leave your email with us, and we'll probably publish this recording on some of our social media pages as well. Okay. So I think we have a couple of questions, maybe one from Velai Chami, who asks, whether we can sell a covered call for US stocks. So the answer for this is can. Of course, you can do so, but when you, I mean, you can do so, But again, the examples that I showed mostly involve futures contracts and gold futures contracts. But of course, like I mentioned, the underlying can be anything. It can be stocks, it can be ETFs, as long as there are options for that specific underlying. Yeah, so the answer I would say is yes, you can sell covered call for US stocks. So okay, I think there's another question from Vilai Chami who wants to see an example in the platform. I think Ming Hui has already addressed your question. So do follow up with us. I think our team will proceed to contact you outside of this and go through a platform demonstration with you. So do follow up with us, and maybe just await for an email from our team. Any other questions?
Danish, I think there's one last question that had just come in.
So the one from Xian Jim Tay, is it?
Yep, that's right.
So I think this person is asking whether info from CFTC is similar to PCR. I'm not really sure what you're referring to, um, but I don't think that info from CFTC. I'm not sure if they actually show this PCR ratio. Again, like I mentioned, if you're very interested, we can very easily. It's very easy. It takes me maybe less than 30 seconds. I can very easily calculate the PCR ratio, and then we can provide it for you. So if you are interested, just do look for us. Just send us an email, or like I mentioned, you can just contact us through the office number which I provided. So just let me put the in my email and the number over here. So if you have any further queries, or if you want the slides, do just send us an email. And I believe that we will probably publish the recording on our social media after this as well. So I hope that answers your question.
Yep. Okay, thank you very much for the insightful session, Danish. Before we end the session, allow me to get my screen up again so I can share this exclusive promotion we have for options trading. You can tell what you've just learned from the session with Danish and trade options with Philip Nova at a commission of only 98 cents. Eligible contracts include indices, gold, and crude oil. You can take a screenshot or scan the QR code to check out the full promo details. And with that, we have come to the end of the webinar. Thank you again, Danish, for the sharing, and thank you everybody for your time tuning into this webinar tonight. Feel free to send in your questions via the survey that will be popping up after this session, and we will get back to you as soon as we can. And we will also be sending everyone the registration link to the next options webinar, and also the link to today's webinar recording so you can watch it again if you would like to. That's all for today. Thank you and have a good night.